Okay, let's dive right into this. Welcome to today's Explainer, where we're going to tackle a massive, often overlooked hidden risk in the world of crypto futures trading. Now, if you've spent any time at all in this space, you've definitely seen the endless sea of signal channels, Telegram groups, and automated alerts, all promising to hand you the next big trade. But here is the critical problem. Knowing what to trade is only half the battle. And honestly, it's the far less important half. Today, we're breaking down the fundamental difference between a signal channel and an account-aware risk coach. It's a structural difference that literally dictates whether your account is going to survive the inevitable rough patches in the market.
All right, let's start with Section 1, the tale of two traders.
To really understand the real-world stakes here, let's look at exactly what happens when a single, identical piece of market information hits two very different accounts. Imagine a signal channel posts an alert. Bitcoin long, entry at $61,000, target $63,500, stop at $60,200. Okay, follower A has a clean $10,000 account, no other open positions, and decides to risk 5% on this setup. Very sensible, right? But then you have follower B. They have a $2,000 account, and they're already holding a highly correlated Ethereum long at 10x leverage. And on top of that, follower B decides to size this new Bitcoin signal at a massive 15% risk. The signal they received was exactly the same. The market conditions, exactly the same, but the account-specific risk was drastically, dangerously different. A signal channel has absolutely zero visibility into follower B's overloaded margin. They are completely flying blind.
That brings us perfectly to Section 2, Signal versus Risk Coach. We really need to clearly define the boundaries of what these two totally different tools actually do for you as a trader. So let's do a side-by-side comparison, starting with guarantees. Signal channels survive on marketing, right? You see implied win rates, crazy profit expectations, screenshots of massive green percentages. But a true risk coach offers absolutely no profit or performance guarantees, ever. And listen, that lack of a guarantee is a feature. It is not a weakness. Because any tool promising guaranteed futures profit is actively simplifying away the very real, very dangerous uncertainty of the market. A risk coach operates in the reality of what could go wrong, not the fantasy of what might go right. Now, what's really interesting about this next slide is the contrast in what happens after you actually click buy. Because once you're in the trade, a signal channel basically has nothing left to say. You are entirely on your own. A risk coach, however, provides an ongoing live read of your specific situation. It tracks your real liquidation distance, it monitors your stop status, and it constantly calculates your account exposure the entire time the position stays open. It's literally the difference between someone giving you a map to a jungle versus a guide actually walking through that jungle with you. And nowhere is this difference more critical than when a trade turns against you. When you're losing, signal groups either go completely silent or worse, they urge you to average down and just blindly add to a losing position. A risk coach doesn't do hype. It gives you a sobering, totally factual read of your real liquidation distance. It tells you mathematically what happens to your account if you hold versus exactly what happens if you close the position right now to protect your remaining capital.
Which leads us into Section 3, the structural blind spot.
The reason these responses are so different comes down to a massive structural blind spot built right into how signal channels operate. They are simply not built to protect you. So, the crucial point we need to lock in is captured perfectly in this quote right here. A signal is a claim about the market. A risk readout is a claim about your account. These two things answer fundamentally different questions, even when they are referencing the exact same trade. The market might be trending up, sure, but if your specific account is over-leveraged and seconds away from a margin call, the market's trend does not matter. You are playing a totally different game.
That's exactly why an account-aware risk coach is so vital. It's defined as a tool that reads your live position context. It looks at your existing positions, your prior leverage, and evaluates how a new trade actually impacts you. Because even if you do continue to follow signal channels, running that entry through an account-aware check first changes everything. It completely turns that signal from a blind instruction that you just obey into a simple data input that you review against your own safety parameters. So let's see how this builds into a practical strategy for everyday trading.
Let's look at Section 4, 5 questions for survival.
To actually implement this, the source material gives us this brilliant, practical framework. It cuts through the noise of the market with 5 concrete survival questions. And honestly, if you can't answer these, you probably shouldn't be in the trade. So the first and absolutely most vital question: is your current risk expressed as a hard number? Feeling that a trade is a little risky or pretty safe is a huge emotional trap. A vague decision cannot be reviewed, and it certainly can't be improved upon. You have to know your exact numbers, simply because the market does not care about your feelings.
Moving from those feelings to hard facts requires 3 specific steps. First up, you calculate your risk percentage, meaning exactly how much of your total account balance is on the line right now. Second, calculate your notional size. That's the total value of the position including your leverage. And third, determine your exact stop distance. Because without a defined exit condition, a trade isn't a strategy at all. It's literally just hope.
Now, the next question might actually save your account entirely. Is liquidation far enough away? Why does this matter so much? Because a close liquidation fatally compresses your decision-making time. When the market moves against you and that liquidation is sitting super tight, panic sets in. You lose the ability to think rationally and review your options because the exchange is about to just make the decision for you.
If the answer is no, if your liquidation is too close, the required action is immediate and entirely non-negotiable. You must reduce your leverage or your position size. It is always better to prioritize the survival of your account over trying to maximize a single over-leveraged setup. You just have to live to trade another day.
Moving on to Section 5, Read-Only Access and Trust.
Now, practically speaking, getting this kind of personalized live data requires connecting your exchange account to a risk tool. And naturally, traders are super hesitant to do that. I mean, security is absolutely paramount. So this is where the concept of read-only access becomes the entire foundation of trust. Read-only access means a risk coach can see your balances, it can see open positions, but it has zero permission to execute trades, transfer funds, or make any withdrawals. It is the core principle of least privilege. You get this exceptional account-specific analysis without ever surrendering control of a single cent of your capital.
And this brilliantly illustrates how tools like DRK integrate with exchanges like Toobit. DRK connects strictly on a read-only basis. It takes all that complex account data and translates it into plain risk language, comparing what holding risks, what reducing size improves, and what closing protects. But the actual execution, that stays entirely in your hands. It basically provides the map, but you are the one driving the car.
Finally, Section 6. Stop chasing perfect numbers.
Before we wrap up this explainer, we really need to address a major psychological hurdle here. The crypto industry is totally obsessed with finding magic bullets. A huge mistake you see traders make all the time is searching for the perfect number, the ultimate leverage setting, or a universally flawless stop distance. Listen, those just don't exist. Good numbers depend entirely on your unique account size and the current market volatility. Furthermore, do not expect blind automation or copy trading bots to somehow fix poor personal discipline. Automation just executes a bad rule faster. And definitely beware of buzzwords like AI or smart money. They sound amazing, for sure, but they do not remove futures risk. They merely change the execution layer. Visible risk, real stops, and suitable sizing are what actually keep an account healthy. So, I want to leave you with one final provocative thought to reflect on today. If you are sitting there right now, already in a losing trade, watching the red numbers grow, what is your signal channel telling you in this exact moment? Most likely, it's total silence. And that silence is exactly why you need an account-aware risk coach to translate all that market chaos into clear, actionable data for your specific survival. Thank you so much for joining me on this explainer today. And remember, keep your risk visible and always keep your decisions reviewable.